Welcome to this presentation wherein we'll evaluate the benefits of investing in gold and the expected directional movement in gold price. I am Aninda Datta, the presenter. Jai Guruji Shukrana Guruji. Here we'll be evaluating the various factors going towards making gold a strong investment avenue. The economic and the market metrics like real USD treasury bond yield, USD index, M2 levels, etc. showing strong correlation with gold price. Main factors causing a sharp rise in gold price in the last 3 years. Decline in credibility of USD and the USD denominated treasury bonds as reserve assets for central banks, financial institutions. Increasing use of gold as a reserve assets and as a monetary tool in the financial system. The present and future supply scenario of gold. The benefits and avenues of gold investing in India. Why gold has been considered an avenue of investment since centuries. Gold is considered a safe haven asset and has been the world's most trusted store of value since the beginning of the human civilization. During crisis situations like war, recession, currency collapse, the demand for gold rises since it is not tied to any specific country's economy. Hedge against inflation. Gold tends to maintain purchasing power over long periods. When inflation rises, currencies lose value, but gold prices often increase. The reasons: gold supply grows slowly, 1 to 2% per year, so has low possibility of sudden supply surge. Fiat currencies can be expanded rapidly based on actions of governments and central banks. Portfolio diversification. Gold is a relatively low volatile asset and has low or negative correlation with major assets such as stocks and bonds. This means when equities fall, gold rises. It reduces overall portfolio volatility as gold's volatility is much lower than that of equity and other commodities. Improves risk-adjusted returns. Gold acts as real assets like land or commodities, which provides protection against currency devaluation, inflation during negative real interest rate periods. Hedge against currency depreciation. When US dollar weakens, gold generally strengthens as gold price is measured in USD. Investors in countries with depreciating currencies like India, Turkey, Argentina often use gold to preserve wealth as currency devaluation increases the landed price of gold. Limited supply plus tangible. Gold is scarce and durable, cannot be created by governments at will and is universally accepted. This gives gold intrinsic value and makes it a trustable store of wealth for centuries. Highly liquid. Gold markets are extremely liquid, traded 24/7 and globally accepted. Can be bought as ETFs, bars, coins or futures. This makes gold easy to convert into cash anytime. Cultural and psychological value. Gold is embedded in traditions and social trust like Indians using in marriages, Chinese using for gifting purposes. Now gold is gradually turning into a monetary tool also. Now, gold price generally has a positive correlation with USD M2 supply as gold acts as a hedge against monetary debasement. But the relationship is not perfect, so short-term movements could diverge. This is a chart that depicts the relationship between gold price and the USD M2 supply. From here onwards till this point, there is a strong positive correlation between the two variables. But from 2023 onwards, the gold price has surged even though the US M2 supply has remained more or less constant. As gold price is driven by many factors other than M2 expansion, so since 2023, the gold price has shot up even though M2 level has remained constant. Now this is another chart that depicts the relationship between gold price and the dollar index, US dollar index. This shows a medium level negative correlation. Let's see here the US dollar index rises and then falls, but here the gold price has been continuously rising. Here the US dollar index against rises, but the gold price is falling. Till here, from here onwards the gold price surges, but the US dollar index has remained constant. Dollar strength. Gold often has a negative correlation with the US dollar index because gold is priced in dollars. So a stronger dollar makes gold more expensive for foreign buyers, thus reducing demand. Safe haven demand. During crisis like 2023, when investors flee risk, they buy gold even if M2 is falling. Now, gold price and US real yields have an inverse relationship. When real yields, that is bond yields adjusted for inflation, are low or negative, gold tends to perform better. Since gold offers no interest or dividend, so opportunity cost of holding gold reduces. Historically, gold price has followed strong negative correlation with US real yields. Now, this is the chart that shows the relationship between gold price and the inverted real yields of the USD. Here they are following a strong positive correlation since the real yields have a negative correlation. Since this point, from here on, the relationships have the two variables have diverged. The relationship has ceased to exist. Since the US real yields drive yields of all bonds across the country, so gold price is negatively correlated with the international bond yields. Therefore, gold prices have followed positive correlation with inverted real yields of USD as depicted in the graph. However, since the 2023, the gold prices and the real yields have diverged. That is, even though real yields rose, the gold price too has been shooting up. Thus, since 2002, some other factors are driving up gold prices, causing its divergence from the real yield. Now, what are the factors driving up gold price since the last 2 years? The Ukrainian factor. Gold buying by investors, both institutional and retailers, increases during crisis period as gold acts as a safe haven asset. Outbreaking of some wars have accelerated gold buying in the last 3-4 years. Central banks and the gold rush, the main driving factor. The central banks across the world keep major part of their reserves in the form of US treasuries, but have been increasing their gold reserves consistently, buying more gold. In the current environment, the central banks are expected to continue their reserve diversification process by buying more gold. This chart depicts the gold buying by the central banks, that is, all the central banks of the world combined together. There has been a significant increase in the gold buying by the central banks in the last 3 years, starting from 2022, from this year. US denominated treasury bonds losing its appeal as preferred central bank reserves due to massive US budget deficit, as buyers for USTs are hard to find, thereby raising prospects of fall in the prices of US treasury bonds and the fall in USD index. If USD Fed resorts to quantitative easing to sustain the US government borrowing programs, that's negative for USD and bullish for gold and other assets priced in USD. The declining credibility of sovereign bonds of US and some other G10 countries is inducing some financial institutions, banks, to park a part of their reserves in gold. There has been a marked increase in central bank gold purchases since 2022 as they reduced holding of the US Treasury, as depicted in the chart. The dollar and US yields have often rise and fall in tandem, signaling a positive correlation between the two, as depicted in the chart below. Let's see here, the dollar USD index and the US yields have moved in tandem, showing a strong positive correlation. However, from this point they have diverged. That is, the US 10-year yields have moved, but the dollar index has fallen. Whenever US yields rise, the bonds prices fall. More foreign money chases the US denominated bonds, so consequently the USD index rises. However, in 2025, this historical correlation between yield and dollar is broken and the two variables diverged, thus demonstrating the falling credibility of the US Treasury bonds. As 10-year US Treasury yields surged past 4.6% while the dollar index declined sharply, falling against all major G10 currencies, clearly indicating decline of USD as international reserve currency asset, as capital did not flow to the US denominated assets. This development in international financial market is highly bullish for gold, as gold is deemed to be the next preferred reserve asset. Gold is increasingly becoming back-end monetary anchor in the global financial system, thus pushing up the monetary demand of gold, thereby creating strong argument for price surge. The creation of gold-backed digital currencies. Some talks are going on among BRICS and some other nations for establishment of gold-linked settlement systems for de-dollarizing international trade. Creation of gold-backed cryptos like Tether. Gold as collateral in financial markets. A major new trend is using gold as high-quality collateral for repo transactions and interbank liquidity. Derivative margin. Sovereign borrowing through gold bonds. Retail investing in gold through mutual funds ETFs. Creation of world's largest physical gold exchange as Shanghai Gold Exchange, which focuses on physical settlement. This reduces the dominance of commodity exchanges like LME, which are dominated by derivatives, wherein there is unallocated gold trading. That is, traders could reduce gold price by shorting for much higher quantity than physical availability. This enables international gold settlement at the SGE, that is Shanghai Gold Exchange. Now, some factors create bearish outlook on gold, as no major economy is likely to convert their currency to gold-linked currency. Selling by central banks. Central banks sold gold during the 1980s, but the nominal yield was above 10% during that period. Debt by GDP and the budget deficit were much lower than the figures prevailing now. So probability of central banks selling gold now exists, but is quite low. The further fall in bond prices and the consequent rise in yield could trigger some gold buyers to shift to buying of sovereign bonds. Strong USD may be caused by strong growth in US economy, cutting of budget deficit by US, rate hike by Fed, etc. Strong USD may shift some flow out of gold. Weak physical demand from China and India. China and India together make up around 50% of the world gold jewelry plus retail demand. Strong economic growth causes strong cycles in industrial commodities. Some money may flow out of gold. Reduced geopolitical tension. However, at this moment, the bullish factors are far stronger than the bearish factors. Historically, global annual gold production has been around 3,300 to 3,600 tons in the recent years. But could it be increased in response to increased demand? According to one widely cited estimate from the World Gold Council, reserves, economically viable deposits are about 54,770 tons. What's uncertain and may shift over time is how much of those resources will actually become economically, technically accessible. Discoveries, technology, economics, and regulations will shape that. The amount of gold that could be added to global supply in the future depends on several factors. Economics. Some deposits now classified as reserves may only become viable if the gold prices rise or mining processing costs fall. Technology and mining methods. Improvements, deep earth mining, lower grade iron processing, recycling, etc. could make more of the resource base accessible. Geological discoveries. New deposits may still be found. Resources are not at all discovered yet. Regulation, environmental, social factors. These affect whether mining actually happens. Thus, there is not much scope for substantially increasing gold production in the near future. Gold investing is more prudent in India as the country perennially experiences high inflation and consequent currency devaluation. So gold price in INR increases to the extent of the currency devaluation for a constant international price. The USD INR was 43.5 in 2005, today at 90. The CAGR devaluation rate is 3.5% approximate, reflecting higher inflation in India. The Indian government is unlikely to control inflation in future more than the current inflation levels. The price of 10 gram 24 karat gold in 2005 was rupees 6850. The price in December 2025 is 129,000, thus giving a CAGR of around 15%. The equity index has provided a CAGR of around 16% during the same period, but the volatility of the equity index is much higher than that of the gold. Gold investing could be done in India in a safe way through mutual funds ETFs, who in turn buy and store physical gold against the money received. Gold trading could be done through futures and options in MCX. However, expert knowledge of derivatives is required for trading in the MCX. One may also buy sovereign gold bonds whose redemption value is linked to gold price prevailing on redemption date. Investing in gold mining companies is an indirect way of investing in gold. However, there is no listed gold mining company in India. The gold mining companies could be benefited both by higher price and mining higher quantity. There are many global ETFs investing in listed gold mining companies like VanEck Gold Miners ETF and iShares MSCI Gold Miners ETF. So this concludes this presentation. Thanks for watching. Jai Guruji, Shukrana Guruji.